Welcome to a new video where we will break down one of the most important trends in today's market. Today, we will explore how major tech companies are increasing their investments in data centers powered by artificial intelligence and what impact this could have on the industry and the financial market. As always, we will present a dynamic chart based on the image displayed on the screen. This chart will illustrate the growth of CAPEX spending by major tech companies in recent years and how it is projected for 2025. With this visual representation, it will be easier to understand the magnitude of these investments and their market impact. CAPEX, or capital expenditure, is the money a company invests in acquiring, maintaining, or improving long-term fixed assets. These assets include properties, plants, equipment, and technology infrastructure. Simply put, CAPEX represents the investments companies make to grow and enhance their operational capacity for the future. CAPEX investments can be classified into two main types. First, there is expansion CAPEX, which refers to investments aimed at increasing production capacity or improving existing infrastructure. For example, when a tech company builds a new data center, it is making an expansion capital expenditure. Second, there is maintenance CAPEX, which consists of investments necessary to keep existing assets operational. An example of this would be updating servers or modernizing equipment in a factory. CAPEX is fundamental to a company's development, as it helps improve operational efficiency, increase production capacity, and maintain competitiveness in the market. However, these investments often require large sums of money, and in many cases, companies finance their CAPEX through debt issuance, reinvestment of profits, or stock issuance. To evaluate the profitability of CAPEX, investors often analyze financial indicators such as return on investment and free cash flow. Excessive CAPEX spending without a strategic plan can affect a company's profitability, while well-planned investment can generate significant long-term growth. In the tech industry, CAPEX is crucial to maintaining the infrastructure needed to support the growing demand for cloud computing, artificial intelligence, and digital services. Tech companies, in particular, rely heavily on CAPEX to ensure their growth and maintain market leadership. Investments in data centers, telecommunications networks, and specialized hardware are essential to providing faster and more efficient services. In the context of artificial intelligence, companies are allocating record amounts of CAPEX to develop the infrastructure necessary to train advanced models and manage massive volumes of data. Additionally, CAPEX in the tech sector is not limited to physical infrastructure but also includes investment in advanced software, automation, and the development of new technologies. A company's ability to efficiently manage its CAPEX investments can determine its long-term success in the industry. Companies with well-defined strategies in capital utilization can gain significant competitive advantages over those that do not prioritize expansion and modernization. Another important aspect of CAPEX is its impact on a company's valuation. Investors closely analyze financial reports to assess how CAPEX affects revenue growth and profitability. A high level of CAPEX without adequate returns can be a red flag, while strategic and well-planned investment can be seen as a sign of strength and long-term vision. The AI revolution and CAPEX spending. In recent years, we have seen an accelerated transformation in the tech sector. Artificial intelligence has evolved from an experimental concept to an essential tool in multiple industries. This growing demand has led giants like Amazon, Alphabet, Microsoft, and Meta to allocate record amounts to the construction and expansion of their data centers. To better understand this phenomenon, let's look at the dynamic chart on the screen. Here we see how these companies' CAPEX spending has evolved from 2023 to 2025. In 2023, capital investment for these companies was around $150 billion. By 2024, this number increased significantly, and according to projections, in 2025, it will reach at least $315 billion, more than double what was spent just 2 years earlier. Why are these companies spending so much on infrastructure? The answer is simple. Artificial intelligence requires enormous computing power. The most advanced AI models, such as those used in virtual assistants, industrial automation, and natural language processing, need large volumes of data and real-time processing. This is where data centers come into play. These facilities allow companies to handle millions of transactions per second, store massive amounts of information, and train increasingly sophisticated AI models. However, building and maintaining these centers is not cheap. That is why companies like Amazon, Microsoft, Alphabet, and Meta are allocating record amounts to sustain their growth in this sector. It is not just about physical infrastructure but also the technology within these centers. Companies are developing their own AI-optimized chips, aiming to reduce costs and improve the energy efficiency of their systems. Google, for example, has created its TPUs, while Microsoft and Amazon have developed their own semiconductors focused on accelerating AI processing. At a global level, other countries are also investing in this sector. China has doubled its efforts in developing advanced semiconductors for artificial intelligence, with companies like Huawei and Alibaba expanding their capacity in high-performance computing. The European Union, for its part, has launched initiatives to strengthen its technological infrastructure and reduce its dependence on American and Asian manufacturers. Looking back, this is not the first time the tech sector has made massive infrastructure investments. During the dot-com bubble in the late 1990s, many companies spent large sums on data centers and fiber optic networks in hopes of exponential internet growth. While some companies did not survive the bubble burst, the infrastructure built at that time was key to the development of the internet in the following decades. A similar phenomenon occurred in the 2010s with the rise of cloud computing. Companies like Amazon and Microsoft invested aggressively in data centers to offer storage and processing services in the cloud. These investments turned out to be strategic, allowing them to consolidate their dominance in the sector. Investments in artificial intelligence and data centers are paving the way for the future of technology. The amount of money companies are allocating to this sector gives us an idea of the importance AI will have in the coming years. Throughout this video, we have seen how major tech companies are doubling their infrastructure spending to support AI growth. We have also reviewed the history of tech investments and how this cycle compares to other key moments in market evolution. It is evident that artificial intelligence is not only transforming how businesses operate but also impacting the global economy. As these investments continue to grow, we may see new business models and opportunities that did not exist before. If you want to keep exploring how these trends could present market opportunities, I invite you to watch our latest video, where we explain why the Magnificent Seven could be in a key buying zone, as they are above their 200-period moving average, a level they had not touched in several years. Don't miss it.